Good evening, everyone. My name is Janet Fishman, and my company is called Hope Organizers. Tonight, we have Stuart Hollins with CSMC Mortgage, and everything in life involves organizing. For example, if you want to buy a house, you have to organize all the things that are involved to buy a house. One, you might start searching online, looking to see what is available in the neighborhood that you want to buy in. Then you might contact some real estate agents to see which agent you resonate with and who you'd like to work with. And then you have to arrange dates to go with them and look at houses. You have to, once you decide on a house, then you have to arrange to have an inspector come in and inspect. And then you have to call different loan companies to get loans. And then you have to work with the escrow company to open escrow and get all the documents that they need and that the loan company needs. And then if you need to do any remodeling or painting, you have to coordinate all of that. So everything in life involves organizing. And tonight we have a person who's going to talk to us about how to get a loan, or if you want to refinance, what are some of the tips for refinancing? And Stuart, can you give a little background, a little introduction too about how you, your background and how you came into the business to start?
Sure. Well, I've been in the business for about 20 years, and I kind of fell into it. I was a network engineer before this, a defense contractor. I've been a QA engineer, mostly electronics and engineering, and I got laid off at a defense company. They were doing layoffs. I got laid off. And one of my clients, side clients, was he owned a brokerage, mortgage brokerage. And he said, well, why don't you come over and do loans? I had nothing better to do, so I did. And that was right before the crash, so the timing was not good. But I made it through. And here I am. It's been fun.
Good, good. Well, what would you say is the first piece of organizing advice you would give to someone who wanted to buy a home and take out a loan?
Well, actually, I was listening to you. The first thing you actually want to do is talk to a lender. Now, I know that sounds like because it's coming from a lender, but a realtor won't even take you out looking until you have a pre-approval letter from a lender, unless you're paying cash, which I hate cash. But they won't even talk to you because they know that not everybody's qualified and there could be problems along the way. So you really want to talk to the lender, and again, like years before you even plan on buying. The sooner the better, so we can start planning. But he's going to need to get you prepared. Then he's going to need to run the credit and collect all the information, and then he could issue that pre-approval letter. It's not a pre-qual letter, which is almost worthless. It's a pre-approval letter. So he's done his due diligence and he's checked everything out, and he feels pretty confident, and he has to, that if you go into escrow, you're going to close, because if you don't close, it's not pretty. So really want to talk to the lender first, and then get a hold of a realtor, and then so on, because they're going to ask, do you have a pre-approval letter? Period.
Especially now with the houses skyrocketing, it's good for people to know what they can afford, have a realistic knowledge of the range, the price range that they need to stay in. They may think one number, but then the lender will come back and say, oh no, you really need to look in this category, in this price range.
Exactly. And as rates keep going up, we have to requalify them. So as rates go up, I have to go into my system and figure out, okay, that was their max. Well, if rates went up, now their max went down a little bit. And yeah, my job is to give them a limit. They don't have to go to that limit, but they need to know what the limit is. As long as they stay under that limit, they're good to go. But it's good to know, because you don't want to go look for a $1 million house if you can be approved for 800,000 or vice versa. Like I said, it's just going to be wasting your time and everybody's time.
And how long are those letters good for? 30 days, 60 days?
Well, the credit is good for 120 days. But again, you have to allow time to get into escrow, and 30-day escrow usually, maybe 45, depending on the situation. And you know, you've got to close before that runs out. Now, technically, the approval letter is good kind of almost forever, as long as nothing changes. So as long as you didn't take on any debt, as long as your credit score didn't move or anything like that, nothing changes, then it's good. But if the credit has expired and you get into escrow, I'll have to run the credit right away to make sure that we're still good.
What documents does one need to gather when they want to take out a loan?
A whole bunch. Actually, it depends on your situation. If you're just a W-2 person, you know, you do your 40 hours or whatever, then basically W-2s, pay stubs. We'll need a copy of your driver's license. There's a, you know what, I put the whole list out here and then I got rid of it here. But basically, you probably won't need tax returns. That's if you're self-employed, then you're gonna probably need tax returns. If the money is coming out of an account, we'll need 2 month statements for that account, and showing the money in the account. That's it's really, if you're W-2, there's not that much we need from you really. It's pretty, because then when we run the credit, that gives us a lot of information too. But again, self-employed, just be ready. Then you may need 12-month statements. You may need again, tax returns, corporate tax returns, and personal. And there's a whole, you know, slew of extra paperwork you may need if you're self-employed, and that's what it's really important to plan early.
If someone closes a credit card, does that impact the credit report that much?
Yes, because there's a couple things. There's three like main things in your credit report. Number one is paying on time. That's like 40%. That's huge. The second is usage. Meaning if you have a $10,000 limit credit card, you want to keep it under 3,000, 30% usage. When the credits run, the credit report's a snapshot in time. So, you know, you can do whatever you want, but except missed payments, of course. But when that credit is run, you want it under 30%. Now, they look at each card, and then they look at the overall. So, you know, if they want to make sure you're 30% usage on each card and overall. So if you delete a card where you had a $10,000 limit, well, your overall limit just went down. So that's why you really don't want to, and most importantly, you definitely don't want to start any new credit. A credit run could hit you 40, 50 points and take up to a year to recover. And that's if you pay it on time.
You mentioned something about starting years in advance to organize this process. Can you elaborate on what you mean by this and how you help people analyze their financial position in regards to buying a house or refinancing?
For instance, I've had people come to me and say, okay, we're ready to buy a house. And then I looked at their information. I found out they bought 2 cars about 2 months earlier. And they didn't think anything of it. Well, a $450 payment equals about $100,000 in loan amount. So if you were qualified for $500,000 loan and you got that $450 payment, now you're qualified for a $400,000 loan. So the difference is big. So even buying a car 3 years ago can make a difference. It's all debt to income ratio. Money in and money out. If you make 10,000 gross a month and you have 5,000 going out, that's 50% debt to income ratio. And part of that is student loans, credit card payments, minimum payments due, and car payments, RV payments, even a lease. I had a client that got a $1,300 lease while in escrow. Luckily, we were able to do their taxes because they hadn't done their taxes yet. They were self-employed, so they were able to write off less, and we got them in the home, but that was painful. So you really don't want to do anything financially. Close accounts, open accounts, move money around. That's why planning is important. And again, it doesn't cost anything. It takes about 20 minutes. Doesn't cost you a dime. And then I can tell you where you're at, and then what you need to do to be where you want to be. And then you can take the info or not.
Is there a difference in required paperwork between buying a house versus refinancing a mortgage?
Yeah, a little bit. When you're refinancing, we're going to need your HOA statement. If you have an HOA, if you have solar panels, we're going to need info on that. We're going to need insurance, your deck page, so that we can, see what your insurance is. And we're going to need your latest mortgage statement, because that has a lot of information on it. Who do we call? Who do we send the check to when we fund it, and so on. That's for refinance. But other than that, most of the stuff is pretty much the same. Except, we'll need for purchase, of course, we'll need the contract, but that's what the realtor will send us.
Once someone submits their paperwork to you, can you walk us through the process of what happens next? Oftentimes, applicants get very frustrated that they submit everything they were told to submit, and then weeks later, they get another request for more documentation. And weeks after that, they get asked for more paperwork. Can you walk us through that process and shed light on this for us?
Sure. As far as the process, again, you talk to a lender, you get the pre-approval done. And then your agent, you go look for a house, you know what your limit is, find a house. And by the way, there's a difference between an HOA or a house with an HOA and one without one. Again, $450 HOA, well, that goes against your debt to income ratio. That's knock it down 100,000. So basically, you go into escrow, and then they send us the contract. We look it over, we plug it all in, and then it goes. Well, really, my assistant kind of takes it from there, and she handles all the paperwork and so on. And I keep an eye on the emails going by and make sure things are going the way they should go. We order the appraisal. Lately we've been getting a lot of appraisal waivers. That's kind of nice. So you can actually a lot of times buy a house without an appraisal. So that'll save you $500. So, the paperwork you come to me with may be a start paperwork, but then they may ask you for a few more things. So it's my assistant's job to kind of button things up and make sure she's got the whole file ready and so on. Then it goes into processing. Processor then works on it, checks for, more things that may or may not be needed. There's a lot of stuff behind the scenes goes on. I can't even begin to tell you. There's all kinds of checks they do, and government checks, and especially if you're self-employed, they find out, about your business. Are you still in business? Because that's kind of important to pay the mortgage. So they really, really check it. Then it goes to underwriting, and the underwriter looks everything over and makes sure that the loan is going to go through the guidelines. There's guidelines for every type of loan, debt to income ratio and loan to value and all that good stuff. Credit scores, what kind of income. So they make sure all the guidelines match whatever loan program you're going to be into, which we've already discussed in the pre-approval. We know you're either going FHA, VA, even a reverse mortgage. You can buy a house with a reverse mortgage, which I've done once. That was kind of interesting. But they make sure that, underwriter, signs it off and says, okay, we're good to go. This will pass, because it's going to go to a lender, actually another lender, and then it's going to be sold to Fannie and Freddie. And Fannie and Freddie, that's the guidelines we tend to look at. So, and we have to follow, or it's going to be bad. And then So after they approve it, then basically, again, they always have some extra stuff because they always have questions. And it's more like just buttoning things up to make sure that if Fannie and Freddie have any questions, we have it answered already. And it's little things. There's so many things that could, go a little bit sideways or because no two people are like, no two houses are like, everything's like. So they kind of, go through everything. They may ask for a couple more documents, and then they'll sign it off. And then docs go out, loan docs, and you go sign your loan docs, and sometimes we can fund it the next day and then close it the day after. They usually fund it, say fund it Tuesday and close it Wednesday, and the keys are yours, and that's it. Now, as far as asking for things, what happens is we ask for information. And by the way, it won't be weeks anymore. That was back in the COVID days, and when refis were going crazy. So things will turn around a lot quicker now, a lot quicker. A lot of times we get information, and that information or that paperwork has some info or questions on it that open up more questions. So now the underwriter said, well, wait a minute, where did this come from? Or why is this whatever? I need an answer to that. So then we need more paperwork. And then sometimes that paperwork can open up things even more. So that's why we kind of start out with the paperwork, we think we need. If there's child support, we can use child support. Well, then we're going to need the divorce decree. So I'll ask for that up front. So I try to get as much as I can, but I don't want to overdo it either, because I don't want to put too many questions in. But we wait to see what the underwriter says, and every underwriter is a little bit different. So they may look at the paperwork and think, well, I need that and that answered. And again, most of the time they're just simple things that can be taken care of. And then another underwriter may go, well, this is fine. So they're kind of the gatekeepers to the company, because if they've missed something, Fannie and Freddie won't buy it, and we're stuck with it. So that's how that goes.
How common is it that one underwriter will say, no, we don't want to do this, and you have to take it to a different underwriter? Can that delay the process as well?
It can, but again, these days, not so much. And usually what happens, we'll take it to the underwriter management. Underwriters, they know a lot, but they don't know everything. And that's where, if I see something that maybe they missed or maybe they don't have right, I'll check with my assistant. I'll check with, I'll do some research to make sure, and I'll bring it up to them. A lot of times we'll go to the underwriter management and say, look, you got to you got to sign this off, or you talk to her or him and see what you can do. And again, every underwriter is different. One of them may catch something. There's hundreds of pages, I probably thousands of pieces of paper and figures and everything and they all have to make sense. If this paper says the income's 20,000 or whatever, this other paper that says the income better match. So there's so much paperwork, and sometimes they miss things and they'll do a final check before it goes to doc. And sometimes that's when they'll come back and say, oh, we kind of need this, which drives me crazy, but we kind of need this. And usually it's just something, pretty simple and straightforward. But yeah, those are the things that drive loan officers nuts, which is a short drive.
You mentioned a few already. What kinds of activities should a potential home buyer or refinancer avoid? You mentioned some, and you have a do's and don'ts sheet there. Do you want to share that with us?
Sure. Now, who was it that was on? I think I uploaded it, right?
You have to share your screen. MJ, you want to?
Yeah, so just roll over the screen, and then a little green button, share screen, will pop up on.
Oh, sorry. I thought I like uploaded it or something, but apparently
no.
Sorry.
Okay.
Okay. There's that one. And now my share button disappeared again.
We can see it.
Oh, wait a minute. Okay, there's that. Oh, I see. Oh, it went over there. Okay. All right, there you go. So you can see, can you see both of them?
I cannot, no,
Oh.
now we see the email, the other
Okay.
one that's like a Word document. Why don't you go back to the other one that was blue, the
Yeah,
do's
so
and the
we can only,
don'ts?
I can only share one at a time, right?
Yes.
Okay, there you go. Yeah, the other one, that's when we go into escrow kind of. And and then it goes more into depth about the process and what you should do. And, you know, when my assistant asks you for documents, get them to her yesterday. That's but yeah, so new accounts, we don't want to take on any new accounts. Again, if they run the credit, that can hit your credit score big time. Now, interesting about that, if I run your credit and then another lender runs your credit a week later, that counts as one hit. If another lender runs your credit a month and a half later, that's two hits. If I run your credit and then you have a bicycle shop run your credit, that's two hits. So as long as it's the same type of credit run, that's one hit. And they do that because they know you may be shopping around. Now, of course, you would never go out while in the process and, you know, try to buy something or have your credit run, but it does happen sometimes. So let's see, close accounts, you can, oh yeah, mattress money. If you have, matter of fact, I just did a cross qualification recently. If you have $10,000 in your mattress, keep it there. There's a way to transfer it kind of into your bank account, and that is use the cash instead of what's in your bank account. And that way the cash in the bank account stays there and builds, and you're using your cash from the mattress. So that's kind of an, you know, roundabout way of transferring it into your account. But do not, excuse me, do not take it to the bank and make a deposit. That would be bad. They don't like money coming out of nowhere. It's weird. They think we're supposed to be the money laundering police and all that kind of stuff. And they're always watching everything. And if an underwriter sees, you know, money just coming in, they're just going to say, nope, can't use it, or may not be able to use the whole account. So, you know, that's what they do. Again, we've got the don't buy any cars, motorcycles, or anything. Moving money around. Yeah, people think that, okay, if I'm going to get it all in one account, or I'm going to, you know, every time you move money, we have to trace where that came from. So if you moved $2,000 from one account to the other, well, now we need statements for both accounts. So really, it's best to, and this is why it's important to talk to me even years before you even think about it, to try to keep all your money you're going to use for that transaction in one account. So you're not moving money around, and then we have to ask for statement after statement. I've seen it where they're moving money around even during the transaction. That's just, I'm getting a headache thinking about it. You cannot borrow money for the down payment. You can get a gift, and they'll have to sign a notice saying that it's a gift, and you don't have to pay it back under penalty of perjury. Now, if someday you pay it back, well, okay, then there's no problem with that. But it has to be a gift, and they will have to sign that letter saying that you don't have to pay it back. So keep that in mind. And then we may have to get a statement from the donor, you know, showing where the money came from. Yeah, paying down debts. Don't need to do that. Again, not till we talk. You may qualify with those debts. You may instead need that money for a down payment or for closing costs. And your debt to income ratio may be fine with those debts. You know, may have $200 worth of debts, but the payments, and we look at the minimum payment due. We don't look actually at the debt. We look at the payment on that debt. So that's why it's best not to pay it off or do anything until we talk. Again, don't do anything financial, opening accounts, move money around, closing accounts, breathe. No, sorry. Don't dispute any accounts. So I don't know if I want to go down the whole list if you want me to, or.
Let me ask you a couple questions. What if
Sure.
someone has student loans? They shouldn't pay off their student loans?
No.
Okay,
We
interesting.
go by, when we run the credit, we'll see the student loan, don't worry. I saw one today. We go by what the credit report says. If there's a number, if it says well, like today, I saw one $8,000 balance, 40, I think it was no, there was no payment. So if there's no payment, we take, usually it's 1%. Freddie will allow you doing a 0.5% times the balance, and that's what the monthly payment is. Fannie generally goes 1%. So if it's $10,000 balance, we go 1%, which is a $100 payment, and we hit you for that. But we have to hit, even if it's in forbearance or whatever, and you're not making payments on it, we have to hit you for it. It used to be we didn't, but that's what we have to do. So you really, and the payment on that is, $100 for $10,000 debt. You may, that it's better to save that money. And it may be actually better than put that $10,000 as a part of the down payment extra, to lower the balance. So.
And what about if someone has had savings bonds, Series EE savings bonds that they've had their whole life, that they got as children or something? If they wanted to cash those out and use those for a down payment, that they would have to show proof that they cashed those bonds to show where that money came from.
Yeah, keep in mind, just everything you do, paper trail. You're gonna have to prove where that money came from and that you owned it and so on. Selling a car for down payment. You better document all that, and you better prove that car you sold for 10,000 was really worth 10,000. And again, that's more of the money laundering stuff and so on. But they want to make sure that the money's coming from something real. So you want an appraisal or whatever of that car that's worth 10,000. Then you have the bill of sale for 10,000. You have a copy of the check for 10,000. And then you have a copy of your statement showing the check going into your account. Again, from start to finish, paper trail, like a detective. If there's a missing link, then it's going to be tough.
We've been living in difficult times the last few years. What are some suggestions you can give to people to keep their credit in good standing as they've gone through these rough years?
Number one, I mean, the most, like I said, I think it's 40% is make payments on, even if it's the minimum payment due, make the payment on time, even if you have to do whatever you have to do to make that minimum payment on time. That is because it takes years. It's going to hit you in the beginning hard. It could be 50 to 100 points or more. But then as time goes on, your credit score, as you're making payments on time and so on, will start to build up. But that could take, a year and a half before you get back, maybe even 2 or 3 years before you get back to, if you had an 800 score, it's gonna take a while. So you want to make, even if it's a minimum payment due, make sure it's made. That's number one. Collections. I don't know why these hospitals and so on just can't pick up the phone and say, hey, you owe $20 or we're going to totally ruin your credit. I don't understand, but so you got to be careful with those, and you have to be careful how you handle those. If you just pay it, that can actually hurt you. If you make payments on it, that can hurt you. You want to get that removed, but that's more of credit repair, which I try not to kind of get into. Again, I would say make payments on time. And try not to rack up too much debt. As far as, the next big chunk, about 30%, is the usage. But that's only when we run the credit. It's a snapshot in time. So you can do your usage all you want, and your credit score is going to go up and down because of that. But when we run that credit, it's got to be under 30% usage. Now, keep in mind, you may make a payment last week, and it may not show up in the credit report. because then the credit, the agency or the one giving you credit then has to report to the credit agencies. So you may make that payment, it may be another 30 days before they update the credit agencies, the bureaus, and then I run the credit. So that's why you really want to stabilize things, 60 days out, I would say. Make sure that you're under that 30 and you keep it under the 30. And that's probably the most important. I mean, the rest is a mix of they like to see a good mix, a house payment, car payment, bicycle payment, student loan, credit cards. And you can have 20 credit cards, doesn't matter. Doesn't really hurt you. As long as you pay them on time and keep the balances under 30%, you're okay.
What can one use for a down payment?
They actually have down payment assistance programs, but you kind of want to avoid those because they have a lot of strings attached, and they change the debt to income ratios that you can allow and so on. You can go as little as 3% down on a Fannie and Freddie product. And with that, you'll have to go in and get, it's a first time home buyer program basically, and you'll have to go in and get, take a class and a course and so on. Then the next one up really, well, VA, you don't have to have anything down. And it's interesting. VA loans, no down payment. They are the, how can I say it? They're the best loans. They rarely default. They default less than the other loans. And that's 0% down. So that's VA. FHA is 3.5% down. And again, you can get gifts, for these down payments, but FHA is 3.5% down. Really, if you're going to go conventional, you want to go at least 5% down if you can, because then it's not kind of a special program, and it's, you're going to have mortgage insurance, but that's okay. Mortgage insurance is a lot cheaper than it used to be, a lot cheaper. And people think, well, I'll wait till I save 20%. Well, by the time you save 20%, it can go up another 1%, and the mortgage insurance was, less than 0.5%. So, you've just kind of, and the mortgage insurance will drop off as soon as you get 22% equity. So it doesn't make sense to save money because rates are going to keep going up. So, and to avoid MI, you want 20%, 20% down. For investment property, you really want 25% down. That's when it gets much better. 20%, they're going to smack you around on that rate.
Well, that's interesting. Can you explain the different types of loans that there are? You kind of touched on it here a little bit.
Sure. There's a cornucopia of loans. Let's start with VA. VA is, again, 100% financing. You can bring money in, but you don't have to. There is a funding fee, but you can put that into the loan. It's usually like, I think the first time it's like 2.5%. And then the subsequent use, it's like 3-point-something%. Or, and a lot of people have this exemption. If you have like a 10% disability from the military, you may have an exemption. You don't have to pay that at all. So, and again, you can put it in the loan. So you don't have to come in with it. It goes in the loan. So that's VA. FHA is another government program. These are government programs, these two. And that's 3.5% down. And that's there's two mortgage insurance. There's 0.85, that's monthly. And that stays on for the life of the loan unless you bring in 10% or more. I know it sounds weird. If I'm bringing 10%, why do I need MI? No, it doesn't. You can bring in 20%. If it's an FHA loan, you're going to have mortgage insurance. So there's a 0.85 monthly, and then there's a 1.75 up front. And again, that you could put in the loan. So it's not any extra you have to bring in, but it's that chunk is in the loan. But you're only bringing in 3.5% down, and you can go all the way up to 55% actually sometimes higher, debt to income ratio. VA, most will let you go to 60%, even though technically there's no limit to debt to income ratio. We can get an approval even at 70%. And there may be reasons you can do that, but so that's kind of FHA and VA. And FHA and VA appraisals are a little bit more stringent. You won't get a waiver on those appraisers. You're going to have to get an appraiser, and they're more stringent. When somebody goes to that house, and I've actually had to run over to a house, fix a garage door opener, it had several problems, get it running, call the appraiser, have them come over, sign it off, and then fund it the next day. Everything has to work. It's a health and safety issue. So if it has a light switch connected to a light, it better work. If it has a garbage disposal, it better work. Everything has to under work. That's why conventional is kind of nicer, because it's a little more, they don't look at every little thing like that. You can have things, you can buy kind of a fixer-upper. FHA, kind of not so much, and VA, not so much. VA, you have to have a termite clearance every time, even on a refi. FHA, not necessarily. Same with a conventional. Now, conventional, you have your Fannie and Freddie, who are the agencies that buy the loans and so on. And that's, pretty much 3% down, 5%. You can go 10, you can go 7%, whatever. More than 20% down, and there's no mortgage insurance. But if you have mortgage insurance, again, on those, once you hit 22% of the original house price, it goes away. So that's why, people should not be afraid of mortgage insurance. It's gotten really cheap these days. And there's guidelines, differences to all these loans. They kind of, pretty close in a lot of ways, but there are some minor differences, and that's why we have to look at FICO scores, for instance. If you have a low FICO score, you probably don't want to go conventional. They will just, the rate will be horrendous. And most lenders won't go under 620. I've got one now that's at 609. So we're going FHA, even though she has like 15% or more equity. We got to go FHA, because conventional is just going to be horrendous. So government loans are a lot more forgiving with FICO scores. And again, there's some, you can go higher on the debt to income ratio.
The VA is just for veterans though, right?
Exactly. Yeah. Exactly.
Now, what about if someone is a young couple and they're just starting out, they don't have much credit, and the seller wants to be the lender. The seller wants to carry the papers for 5 years. Then how is it then for them when that ends, if they need to get a traditional conventional loan? Is it hard to do at that point, or that
that's a good question. I mean, it depends on what they did in that 5 years. They could be, I haven't seen that in a long time, and most sellers don't want to do that. And it can happen. It has happened, but it's been a while, and especially in this market, they just want somebody to come in and buy it, and that's it. When they're getting 10 offers, carryback is, but some people may like that, because they can get a good interest rate, on their money. Basically, the seller could get maybe 6% or something compared to the going rates, the 0.5% at their bank. So in 5 years, they really have to hope that they get things together. And of course, I'll help them as much as I can, but the jobs that they get and the income and all that good stuff, and who knows where rates are going to be in 5 years, and that could change everything. Maybe they could qualify for something in a couple of years, but then rates keep going up, and now they're in trouble, because now that person's going to want that loan paid off in 5 years. So yeah, that's a tough one. I wouldn't really recommend doing that unless there's some kind of agreement that, okay, if they don't qualify somehow, they're not going to be, foreclosed on.
What happens if someone has their house in a trust when they want to refinance? they have to take it out of the trust. How does that work with the refi?
Well, some lenders, excuse me, will let you put it back into a trust. And then some won't. What we usually do, and either way, if you want to put it back, it's a pain in the, you know what, you got to get all the trust paperwork, you got to, you know. So what, what we usually do is, our escrow does, is they'll put it in your name, and then a day later, after it closes, or maybe that same day, they'll put it in the trust. And then we don't need all this paperwork. So it goes boom, boom. Now, there's a danger to that if something happens within that few hours or a day, you know, it's not in a trust, but that's something that, you know, people can look at. But, you know, sometimes when I'm looking for rates, I'm looking at the lenders, and you know, one may have a better rate than the rest. That's one we go for, but they don't do a trust. You know, that's where you kind of make that decision that, okay, we'll just put it in, you know, person's name, Joe Schmo, and then the next, again, you have to talk to escrow about this, but I think it's pretty quick. I think it's within 24 hours, they put it in the trust, and they can do that just like that without paperwork and, you know, all that good stuff.
Well, great. This was really, really interesting. As you hear, it's great. And as Stuart mentioned, is that there's times when he has had to really monitor a situation and watch documents and watch paperwork, and he's watching and constantly monitoring. So that is really, really good when you have a relationship with an agent, with a mortgage agent, versus doing everything online and it's all cold and it's a faceless exchange. So it's really, really important to have someone like Stuart helping you through this process. I want to open it up now to.
Oh, and I'm available, you know, pretty much 24/7. I usually have the earpiece on, so you can call me in the evenings. I don't want you to lay in bed tossing and turning, freaking out, because I can answer a simple question that you had. So weekends, weeknights, call.
And does your company work just in California, or do you have surrounding states? What's your scope?
Well, actually, recently we started, and the company has to get licensed first, and then we have to get licensed too. Now, we've already branched out, I think, into 7 or 8 states, but now I have to look at, and this is pretty recent, I have to look at the different states and go, well, where do I want to branch out? Because I have to pay money, I have to take courses, I have to get licensed there, you know, and if nobody moves to those states or does loans in those states, you know, so I have to kind of, I'm still trying to figure that out. I think Florida might be a good start. Yeah.
So let's open it up. Does anyone have any questions they would like to ask Stuart? And Stuart is really good. Even if you live in a state he doesn't cover, he's happy to answer a question and give his opinion on a package that you have been offered. Is there anyone who would like to ask a question?
I have a question. So Stuart, if you have, or maybe you've seen this, a young person who doesn't have great income or actually well-established credit, but they want to buy a house and they have someone like a parent that agrees to co-sign for them. How does that work exactly? And at what point would the parent be able to step aside and let the child take over on their own? Like,
no, and we do this all the time. It's called a non-occupant co-borrower, and VA really, I don't think VA allows it, but FHA and conventional allows it, and we do it all the time. I've got it, the refi I'm doing, the parents are stepping in and going to go on the loan. So they would go on the loan, and they have to supply everything that the client has to, you know, tax returns, you know, I have to run their credit, the whole shot. And so now instead of one borrower, there's 3 or maybe 2, you know, depending on the parents and so on. And then, you know, then we put all the debt together and we put all the income together. and make sure it's that debt to income ratio is still under, 50, preferably on Fannie and Freddie. And then we can do the loan. Now, the problem, well, not really a problem, but something to think about is that debt is now on the parent's credit report, which is not necessarily bad if they pay things on time, the kids pay things on time, and especially over a year, you may not be hit for that debt. Like if you go out and buy another house or refinance or whatever, as long as they've made payments on time the last 12 months, then we may not hit you for that debt, because we know that you're the co-borrower and they've been able to make the payments. Now, if they don't make the payments or they skip a payment, then that's going to affect your credit, of course, because you're tied, and then you're going to be hit for that debt if you want to do something. But you will be on that loan and title until that loan is paid off or they refinance. One and the same.
So essentially, the young person would have to get to a point where he or she could actually qualify on their own for a refinance. That's the only way. You'd have to get a new loan just for them.
Exactly.
Hmm.
Yeah, I wish we could do it, be more flexible and just remove somebody, kind of requalify, and then just remove somebody. But yeah, we basically have to start the process. Well, before the process with a purchase, now it'll be a refinance. It'll be a little bit easier and plus less people on it. But yeah, it's going to be on your credit report. And because you're on title, again, it's a property now that you own. So that's other things that they have to take in consideration.
Okay, thank you.
Mm-hmm.
Are there any other questions? Looks like we have reached the end then. Well, I want to thank everyone for coming tonight. And I want to especially thank MJ Finstrom, who is the owner of a company called Hut Dogs. It's a digital marketing company. And a big thank you to Stuart Hollins for being here to give such a good presentation.
Thank you for having me.
You're welcome. Thank you, everyone. Have a good night.
Should I stay on to talk to you, or?